Good afternoon, everyone. On behalf of 4S Services, I welcome all the participants to Apar Industries Q1 FY19 earnings conference call. Today on the conference, we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Devatkar, CFO of Apar Industries. I would now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Thank you, Lokesh. Good afternoon, everyone, and a very warm welcome to our Q1 FY19 earnings conference call for Apar Industries. I would like to begin the call with a few industry highlights and then follow that up with a brief financial analysis, post which we can open up the floor to questions. It has been a mixed quarter for the transmission and distribution sector, in the sense that despite several announcements and positive measures, there was a decline in the total number of T&D lines and some of the larger projects which were awarded. So this was down almost 39% year on year, from approximately 11,000 crores from a year ago to about 6,800 crores in Q1 FY19. However, we believe that this is probably a bit of a temporary lull, and there are a few positive developments which are there, which I'd like to mention. Power Grid has announced that they are going to spend 25,000 crores of capex for FY19. There has been visible progress on the Uday initiative, where the losses of state discoms are already down 70% to approximately 17,350 crores in the last 2 years from the time the scheme was initiated. The gap between the average cost of power supply and the average revenue of state power distribution companies has reduced to approximately 24 paisa, which is, the gap has reduced by almost 60% over the last 2 years. So this has a major indirect benefit in terms of the subsequent capex that comes up from the distribution companies. Railway electrification projects are also picking up speed in terms of execution, which has resulted in higher order books in our case for both copper conductors as well as the electron beam cables that go into the locomotives as well as the passenger bogies. So Q1 FY19, the railways closed electrification tenders of more than 5,500 crores. Spending in discoms for distribution projects, we have also seen certain discoms picking up momentum. CRISIL has indicated an investment of about 2.5 to 3 lakh crores in the next 5 years for building the T&D infrastructure. We are seeing early stages of revival also in the wind power segment, which was pretty dead for the last 15 months due to a change in the regime from feed-in tariff to an auction. However, the auctions conducted in the last 15 months for approximately 5.5 gigawatts of wind energy have only started being executed and expected to reflect a capacity addition in both FY19 and FY20 as these tenders start getting awarded. Capex spending on solar projects along with new evacuation into the transmission networks remains reasonably strong. The government has estimated an investment of 3.85 lakh crores for setting up 77,000 megawatt of additional solar capacity by 2022. So besides the T&D sector, we have also seen fairly strong growth in the automotive sector. And what is of greatest interest to us especially is the tractor segment, which grew at about 24% year on year to reach volumes of more than 230,000 tractors in Q1 of FY19. So this has helped us substantially increase sales of our auto lubricants to the tractor OEMs, where the company has a relatively strong tractor positioning. And it has also increased sales of our industrial lubricants, which are used extensively in the manufacturing of various types of auto components across sectors that include passenger cars, trucks and commercial vehicles as well as agriculture products like tractors. So this quarter, we have seen a strong increase in revenue led by growth across all the three businesses, which is our conductors, specialty oils and cables. However, we have not been able to show the same level of growth in terms of profitability, as there was a lot of pressure on the profitability due to increased commodity prices, a pretty sharp depreciation of the rupee, and also increase in major input costs, which include packing material, both steel as well as polymer-based, freight, etc. There has been a bit of a time lag, especially in our oil lubricant segment, where we have either struggled to get the necessary price increases, or the formula-based increases are going to partly reflect in Q2 and fully in Q3 based on the formula that we have. If I get into the numbers in a little bit more detail, our consolidated revenue in the quarter came in at 1,499 crores, which is 15% up from Q1 FY18. We saw robust growth in sales of our cable segment, followed by our conductors and specialty oils. The EBITDA for the quarter increased by 16% to 112 crores from 97 crores a year ago, resulting in an EBITDA margin of 7.5%. However, the profit after tax declined by 26% to 29 crores compared to 39 crores that we had from a year ago. And this decline in the bottom line was on account of essentially higher interest cost from the increase in the commodity prices, the increase in both LIBOR rates of interest as well as the domestic Indian rates of interest. There is still some residue of blockage of working capital on the GST, particularly in the form of the third-party exports which were done. We expect a release of this to happen by 30th September as various stages of the process are being completed. And of course, we've seen increased inventory levels that we are holding due to delay in either customer projects or making financial arrangements that customers had to make before we were prepared to release the product to them. So we would like to highlight that in the short and medium term, actually the access to credit scenario is actually pretty tight and is deteriorating, and this is forcing the company to limit sales to customers where it is not wise to increase credit exposure. So this is affecting directly the sales volume to some extent, and indirectly the profitability, as the pricing to the more solvent customers starts getting a bit more aggressive, so that the sales ticker continues to run. So these are the general comments I have. I would like to spend the next few minutes talking a little bit more specifically about each of our three segments. So coming to our conductor segment, the business posted a revenue growth of 17% at 635 crores compared to Q1 FY18. Exports contributed 49%, up from 44% a year ago. So there's a 5% increase in contribution on the export front. The EBITDA per metric ton post forex adjustment reached 12,073 rupees per metric ton, which is substantially higher than the 10,900 which we had a year ago. And this was driven by some of the more profitable high efficiency conductor orders which we executed. So the order mix was a bit more favorable for this quarter. The high efficiency conductor revenue contribution came in at 13% of our total volumes. The volumes for the quarter were actually a bit lower at 32,281 metric tons compared to 38,267. So approximately 6,000 tons lower, largely due to not receiving enough manufacturing clearances or delays which have happened in the financial arrangements from customers. We ended up actually starting the quarter with the expectation of executing all these, and as a consequence actually hold a slightly higher inventory level. Our sense is that over the next 9 months, hopefully a lot of this should get executed. We have seen a fairly sharp increase in the order book, which today stands at 2,436 crores as on June 30, which is up 110% over the same period previous year. And if you look at quarter on quarter, which is comparing to what it was on 31st of March, it's 101% higher than that period. Export orders contributed to about 36% of this order book, which is also clearly indicating that domestic ordering has started increasing. We have received an order of 394 crores for the new copper conductor business that we have started with Indian Railways. So considering all this, at 2,436 crores, this is the highest historical order book that we have in our conductor segment. In addition to this, the high efficiency conductor business in India is expected to pick up in the next few months, with the visibility of a large number of new tenders, and tenders which were shelved have been revived. So we expect a fair amount of activity on the high efficiency conductor side to take place in the next 9 months, which is a pleasant change from the last 6 months where it's been rather subdued. A lot of this 2,436 crore execution is expected to happen within the next 3 to 4 quarters. Coming to our specialty oil segment, revenue for the quarter was up 15% at 576 crores. We had fairly strong growth in industrial oil and automotive oil, as well as in rubber process oil. There is a common thread that all three of these segments actually supply into the automotive sector as such. There was a marginal drop of about 2% in volumes compared to the same period previous year, really coming from slower demand and a fairly high and intense level of competition in transformer oil and white oils, both in the domestic market as well as in the export markets. We have seen particularly a major slowdown in demand from the Middle East and the African regions for transformer oil and white oil at this stage. If you come to the EBITDA per KL, after forex adjustment for the quarter, this has declined to approximately 3,100 rupees per KL from 4,072 rupees in the period a year ago. As I mentioned earlier, this is largely on account of the inflationary pressures which we have seen across all the major inputs. And given the fairly tepid and reduced demand, especially in the transformer oil, white oil side, the price increases are taking longer, and we are struggling more to make that happen. Clients are pushing back on price increases, and some of our competitors are willing to either postpone increases to gain market share, or are using this opportunity to open up an account which otherwise they were having difficulty getting into. The credit scenario being weak is also causing problems in this sector, since we have a fairly established system by which we limit exposures to clients where payments are getting delayed. The silver lining to the whole oil segment really has been the auto and industrial subsegment volume. They were fairly strong. We saw a 44% increase in volume on the automotive side and a 60% increase in volume on the industrial oil side. This represents a historical high for the company in both segments in terms of sales in a given quarter. The volume for this subsegment is now at 16% of the total that we have of our specialty oil and lubricant business, and it represents 24% of the value. So we are slowly and steadily moving towards a target where we would like to attain 33% of our volumes coming from the additivated lubricants falling under the auto and industrial segment. The profitability from these gains for us are not reflected fully in this quarter's earnings. Due to the inflationary pressure that I mentioned, price increases have been announced, and in the course of Q2, they will start getting reflected. In the case of some of the OEMs, it's on a formula which will partly get corrected in Q1, and the rest of it will get corrected in the early part of Q3. So Q3 will reflect the full profitability from these price variation formula kicking in for the automotive side. We are now clearly in the top 12 finished lubricant producers in the country today, having pretty much started in scratch in this segment 10 years ago. So this in itself is quite a commendable achievement, and the trajectory is clearly showing a strong upward growth. Coming to our cables business has delivered a fairly robust revenue growth of 26% in the quarter, with revenues coming in at 318 crores. We saw significant growth in the power cables and in the optical fiber cables supplied to the telecom segment, which grew by 34% and 83% respectively. So power cables revenue that increased came from the sales to EPC contractors working on various distribution or discom projects, as well as our strategic positioning in the renewable sector, particularly the solar sector. The telecom revenue has grown on the back of orders which we have received from BBNL, as well as a few of the telecommunication companies and the last mile providers. Our elastomeric business declined by 16%, primarily due to the slowdown in the wind segment, which is virtually dead at the moment. However, there are a number of new tenders worth approximately 300 crores, out of which we expect to receive orders worth about 75 crores in the wind segment, and these should start coming in towards the end of Q2. The specialty E-beam cables, however, from our railways and defense segment continue to grow at a fairly comfortable pace. So EBITDA margin post Forex came in at 9.5% in Q1 FY19 compared to 8.1% a year ago. We are pretty confident that we are on track to deliver a 25% growth in the cable segment in terms of revenue, and our profitability is also expected to come in close to about 9.5% plus minus. So even though the numbers of Q1 for us are a bit disappointing due to some of the factors that we mentioned so far, we stay quite optimistic in terms of the fundamental growth in our businesses. The long-term trends and the business composition which we are looking at are both moving in the direction that the management has set the course for, and should start reflecting, in the next few quarters and in the years to come. So with this, I'd like to end my comments. I would like to thank all of you for joining the call, and would be happy to open the floor to questions at this stage. Thank you.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Vikram Kashyap from Kedia Securities Private Limited. Please go ahead.
Hi sir, good afternoon. I had just 2 questions. Sir, in recent past we have seen inconsistency in the performance. This cable business has shown consistent performance, but majority of the business has failed to do so. My question is, when we are expecting things to improve and show consistency in performance? And second question is, when margins are expected to improve?
So I think let me answer both those questions at the same time. We've seen actually a lot of volatility, and we spoke about that quite a bit at length in our last call. In a sense, things haven't changed. This volatility we've seen across metals where there are movements up and down on a regular basis. We've seen volatility in terms of crude, gas oil, which is also changing the pricing in terms of base oils. And then the inflationary push has been pretty severe in terms of additives, packing material, freight costs, steel, etc. So our sense is that it's still going to take another quarter or so, or 2 maybe, for it to start stabilizing. Like oil was supposed to hit 80, was predicted to hit $80. It's now fallen actually to 73 or a little below 73. So this business has been a bit affected by volatility. the Indian rupee versus the dollar actually depreciated quite strongly just towards the end of the quarter. So, you have all the MTM losses which have been repegged for the quarter. So, our sense is that this is going to continue for some time. So, we don't really have any special solution to sort this problem out. The only underlying benefit which we see is that, we are moving to better value business, as the HEC comes in on the conductor side, copper conductor business now getting established. On the oil side, the auto and industrial lubricant business growing. On the cable side, the profitability is being driven by a lot of the specialty products. And the demand, as I mentioned earlier, for those, which is coming from the railways and defense particularly, they continue to be coming in at a reasonable growth. In addition to that, we've been able to fundamentally leverage, the infrastructure which we created on the power cable side and the optical fiber side. And the variety of products that we've developed on the cable side is very high, which is what is helping, the business to remain, to remain robust. So I think the worst is not still. I mean, the volatility is still there and probably continue for a bit.
So my question was, because in previous calls in FY18 we had reflected that majority of the FY19 is going to be good for the company and rest of 2020. So quarter one was a bit disappointed for us if not on top line, but definitely on the bottom line side. So for the rest of the year or going forward in 2020, do you see pickup in top line and bottom line growth, and we are going to hold on it, just the way you have improved on your performance, you added products and many of the initiatives you have taken in terms of adding capacities. So are they going to help us improve our performance, not it got Q2 or Q3? And
so we've set ourselves up to do that, but then what's happening is that, you've got some of these other volatility things taking away from, the margin loss coming from that, taking away from it. As I also mentioned that the lubricant side, the volumes have increased, but the formula pricing that we have is backward looking. So even the formula to the OEMs will get corrected in Q2 and fully in Q3. So at this stage, I think I'd be in a better position to answer this question maybe when we have a Q2 earnings call, with another 3 months having passed by, to see how much stability is there and how much of this price increases which we've pushed in the market is actually getting reflected.
Right, sir.
Yeah. Okay. Thank you.
Wish you best of luck.
Thank you. Next question is from Girish Raj from Quest Investments. Please go ahead.
Yeah, if you could just share working capital related, so receivables and debt at this point of time, as in the first quarter.
Yeah. Devakar, would you like to take that? So the net working capital. The net working capital situation, actually we've managed to contain it and keep it at pretty much the same level.
Oil capital employed is about 458 crores. And conductor is 419 crores and cable is 492 crores.
And what was the position fourth quarter, sir?
Which one?
All three.
417 crores oil, 455 crores conductor, and 408 crore cable.
Okay.
Line with the increase in, it's pretty much in line with the top line.
Okay. So in this interest expenses, 38 crore is related to interest cost and banking charges. So if the commodity and currency remains at this level, is it a fair run rate to be maintained over next 3 quarters?
Yes. It will be close to around, the average will be about 35-36 crore per quarter. But the top line will be much higher actually. Because especially in case of conductor business, The activity level was for about 44,000 metric ton, but we ended up with only 32,000 metric ton of sales and 36,000 metric tons of production.
Sure.
So, just to add to that, if you see the sort of rough breakup that's there for the interest. So, our suppliers credit for, the overseas supplies is around 10 crores out of this 35. The domestic LC interest, which is, from the aluminum and copper which is purchased for the conductor and cable business, is around 12.5 crores.
Okay.
6 crores is actually the discounting cost. See, today all the EPC contractors, including the really big players, that would include people like L&T and Siemens, AVP, KEC, Kalpataru, all these guys, they all want extended credit.
Okay.
On a letter of credit. So that discounting costs are around 6 crores, which is actually built into the pricing, that one would charge to them, given that these credit terms are declared upfront, at the time of your quotation itself. Then we have an interest of about 2 crores on GST. Half of which is actually pertaining to a last set of residual refunds that we should be getting from third-party exports, which were done about 8 months ago. So that process has now got set properly, and it's in a very advanced stage of getting released. So by 30th September, about nearly 65 to 70 crores of that money would get released. And that is not going to be a recurring amount getting stuck, on GST, but the interest on the GST is about 2 crores and our term loan is about 3 crores. Okay. So if you add all this up, it comes to about 35 crores. So you've got term loan and interest on GST actually going to come down, and the rest of the cost will kind of pretty much stabilize.
But the top line will be much higher.
Top line should be higher, and as I mentioned in the call earlier, there were a number of indications of manufacturing clearances that were expected in the first quarter. So the raw materials, everything was lined up. But some of that has not happened. Part of it is because of all the stress which is there in the banking system. So EPC contractors also are struggling with, making sure that LCs are opened. Opening of LCs is taking a lot longer than it was taking earlier. But our sense is that, the pace of activity will pick up in the next 9 months.
This extended credit asked by the EPC players, is there a reset in the pricing, or how does that work?
No, so in most cases, they tell you upfront only when you're quoting.
Oh, okay.
That I'll open a 180-day LC or a 120-day LC. So you have to factor that into the equation while quoting the price. But bottom line is that there is a certain cost to the capital. So if previously an EPC was buying at 60 days and 90 days, they've now moved, to 150 days or 180 days.
Oh, this is a recent phenomena after March, or?
No, it's been happening since the last maybe 18 months, but now it's sort of become a standard.
Okay. On this railway order, is it fair to assume 15,000 rupees EBITDA per metric ton? This 400 crore order?
It will be about 12,000, 12,500 rupees.
And on this 400, what would be the tonnage that may go?
About 7,700 metric ton.
Of 400 crore order, right?
Yes.
Yeah.
Okay, sir. Thank you very much for that.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. Next question is from Varun Agarwal from BOI AXA Mutual Fund. Please go ahead.
My question is your volume growth in terms of the oil segment.
Could you speak a little louder, please?
Can you hear me now?
Yeah, we can hear. Thank you.
So basically my question is with regards to the volume growth in the oil segment.
Yes.
Do you see that picking up going forward? Because you said a lot of, the clients have postponed and probably the sales are restricted due to the credit position. How do you see that panning out over next couple of quarters?
So, in terms of the automotive and industrial side, we expect, the sales growth to continue because there's a fairly strong momentum coming from the automotive manufacturers. Both OEM as well as even we've seen growth on the distribution side. So our volume estimates which we have, considering that the first quarter was a little bit lower than what our plan was, is to still do between 400 and 415,000 KL overall in terms of total volume. We, typically the season for transformer oil and white oil comes in Q3 and Q4. That's the stronger period. And our expectation is that it should continue to be the execution will be stronger in those 2 quarters. But the industrial and automotive will grow by over 30% year on year for sure. This quarter has been a little bit higher because, of the base effect of GST, which has been there. But still, overall, we deliver a 30+% number on physical volume in the automotive and industrial side. The transformer oil and white oil is difficult to predict the volume because we look at both, a certain threshold level on margin as well as, there's a limitation coming in, particularly on domestic transformer oil in terms of credit quality, of not wanting to exceed certain exposure with clients. But overall, considering everything, between 400 and 415,000 KL is what we are trying to target for the year.
Mr. Agarwal, I'm sorry to interrupt, but we still can't hear you.
Can you hear me now?
Yes, please go ahead.
So, in terms of EBITDA per KL for the oil segment overall, as you mentioned that over the next couple of quarters, probably we'll see the improvement or the price variations clauses kicking in. So, do you think that we'll be able to match the last year's overall EBITDA per KL number?
So the target is to get to that level, and our expectation is that Q2 and Q3 should be much higher than what the current 3,100 per KL number is. I think at the half year level we'd be in a better position to be able to comment on that. It seems like, the depreciation of the rupee will not happen that sharply anymore. It's, even though today it has fallen, but it's in a certain range, and, the sharp decline has already taken place. The crude also seems to be moving in a certain basket, plus or minus. So if these two things stabilize, actually we don't mind whether the price is either at $70 a barrel or whether it is at $90 a barrel. The fluctuation is what keeps hurting the business, because you go for a price increase, and if supposing the price falls and the client pushes you out saying, wait for a few more months, it may correct itself. And so, the pass-through gets delayed. Same thing happens when, the rupee depreciates, then, you've got to go in and there's a time lag for getting the increase in price. So, moment the stability on these two fronts fall in place, and you'll start seeing, particularly on the transformer oil, white oil side, the margins on a per unit basis picking up. So I would imagine that numbers would be better than what they are in Q1. But, and hopefully it should be closer to the 4,400 which we saw last year. The target which we have for this year, sorry.
Sure. So, one last question on the conductor side. The EBITDA per ton was really good in this quarter. As you said, that some railways order were coming in. Do you think this number will be closer to the guidance which you gave, or will be better than what you have mentioned?
The guidance which we had given was about 10,000 rupees a ton for the segment, and even though this quarter it's come up at little over 12,000, I think we should be able, we would still feel that it be closer to that 10,000 a ton through the year. Though, as I said, the order books have gone up substantially. In some cases, there has been competitive pressures while taking the orders. But it's a very good sign of the domestic demand starting to pick up. We mentioned in our earlier call that in many cases, the TBCB lines which were there, the tariff-based competitive bidding lines, the EPC contractors and the developers are not releasing the orders because they wanted, the aluminum prices, which had shot up significantly, to come down. It seems that it's at a level where, it's not very likely for it to come down much below this. And that's the reason why, the orders are starting to get placed. And from our comments earlier, the order book is at a fairly strong level. So you will see operating leverage starting to kick in also, at all the plants, because as the clearances come, the conductor side will start running flat out. The copper conductor is on a very tight time schedule because of the aggressive deadlines on the electrification of the railways. So we expect that entire 7,700 metric tons to get executed in this financial year itself. The third thing on that is that the high efficiency conductors, a number of tenders which were postponed, they have been all revived. And in many cases, they're running out of time in terms of being able to place these orders before some of the lines start getting maxed out. So overall, we are at this 10,000 per ton, but there are some upsides which could potentially be in place if all this comes through.
And in terms of volume growth, you said the domestic overall demand situation is also reviving on Uday and power grid side. So can we overshoot the target there on the volumes, or you think it's still early days there?
We expect the volumes to be about 180,000 tons this year, although in the first quarter we had less volume because of the manufacturing delays. But as the order book has improved and also now the LME levels have come to some normalized levels, we expect more manufacturing clearances and placement of business. So we hope to catch up in the next few quarters.
Thanks a lot, sir. I'll get in line for more questions.
Okay.
Thank you. Next question is from Anupam Goswami from SMIFS. Please go ahead.
Yeah, good afternoon, sir. Just a couple of questions. Can you tell me what is your current debt level? Because I'm yet to believe that your finance cost has been shot up almost double, more than double in fact. And you said one of the reasons is that the Indian interest cost and also in the foreign interest cost has gone up. But has your debt level has also gone up? And just want to know from that side.
Well, actually the cost is up from about 20 crores to about 35 crores. It's about a 15 crore delta.
If you see year on year, but if you see quarter on quarter, it is more or less in line with the fourth quarter actually.
Yeah, but on a debt level, is it within the same level or has it increased?
Slightly increased actually, debt level actually. In the sense we do this LC financing actually from the supplier's credit, that has slightly increased. But what has happened is, see, LIBOR interest, which was about 1.4%, is now about 2.5%. And the local interest has also gone up, domestic interest. Plus, because the money is stuck up in the GST actually, as of now about 68 crores of our refunds are pending and about 99 crores of GST balances are there. So because of which also the funds are involved in this. See, basically what has happened, the export business has become costly for financing. Earlier, for export business, we were able to get the material without payment of any duty, without payment of basic duty, CVD, SAD, etc. Whereas now, while bringing the material, first we have to pay 18% GST. And it will remain in the entire manufacturing cycle, say 60 to 75 days. And after we sell, they had promised that they will give refunds in about a week's time, say 15 days time. They are not giving refund for 3 months, 4 months also.
So, do you think that there will be a bit of crunch on your working capital?
There is a pressure on working capital, and that is why the interest cost has. So this was reflected in our quarter 4 also.
Okay. So, this is, are you saying that this is going to sustain like this only, and
for some time it will sustain.
On an overall basis, we can say interest cost can go up a bit.
Correct. Plus, because of the commodity prices going up,
overall interest cost will remain in this 35
range. Actually. No, he is comparing with quarter 1 actually.
So that 20 crores is going to stabilize at around this 35
crores.
Because the interest rates are not coming down, the volume will go up.
Yes.
But some of these GST monies and all these things are getting all released. So by September, that equation will start getting cleaned out. The old monies that are stuck. So overall it will be in the same range, the 35 crores plus minus.
Plus, because of the commodity prices increasing and the increase in rupee dollar rate, for doing same volume of business, you require more money.
Right. And so, next question is, so what is your capex? Any plans on capex?
Our capex plan is about 110 crores.
Mm-hmm.
And in the first quarter, for the whole year.
Yeah, and that is for which segment? There
is about a new project which we discussed last time, CTC conductors actually, continuously transport conductors. That new project is there in the conductor division. That is taking about 45 crores. Then about 25 to 30 crores in cable business. And balance is in oil business.
So in cable and oil, how much expansion are we looking at?
So on the oil side, actually, most of the money is going into increasing the automation and the packaging capability on the automotive industrial lubricant side. So the effective capacity will almost increase by around 70 to 80%. Once that project is completed with higher automation, same number of employees, etc., etc. A whole lot of productivity parameters will get hit. And on the cable side, most of it is all debottlenecking and adding additional capacities on. There's something coming on the optical fiber side, given the product mix that is moving towards ribbon fiber optic. There's some debottlenecking happening on the power cable side. Couple of equipments coming in on the elastomeric side. So it's spread out across, and really it's to help us, take our turnover this year to 1,400 crores, and next year, increase by another 200 odd crores. So all this that's being lined up should basically take care of that.
And also, you mentioned the new project CTC. When can we expect it to complete and start production?
So the CTC will probably be in April of 2019, when we'll be able to start production, and then it will take about another 3 to 6 months to complete getting all the approvals, because it's a very critical component in the core of a transformer. But really, revenue will start coming in 2020, financial year 2020.
2020. Okay, sir. Thank you very much.
Thank you.
Thank you. Next question is from Adit Makijani from B&K Securities. Please go ahead.
Thank you for the opportunity, sir. Sir, I would like to understand your outlook on the capex on transmission from state transcos and PGCIL. Especially in terms of execution, as we see certain EPC contractors have been slowing down their execution, maybe because of elections coming and all. So I would like to understand your outlook on that.
So Power Grid is going on with about 25,000 crores capex target for this year, and they may be quite on course in terms of meeting their plan. And they are generally good paymasters, so there should not be a slowdown on the Power Grid part. Yes, there is a overall not much growth on the interstate transmission, but on the other hand, in the state transmission business, there is a lot of activity going on, and a lot of the business which has been coming in nowadays to us also is on account of the state transmission business through EPC parties. So some of the payments for some of the boards are delayed, but on the other hand, there are good paymasters in some state transmission companies as well. So it's a mixed situation. Some EPC guys who are having the good business with good paymasters are going very strong. In fact, there is a pressure to complete the jobs ahead of schedule also.
Okay, sir. Thank you. And sir, one more question regarding cables. So the cables business is growing quite nicely. And I would like to understand why don't you guys like move on to the retail side also, since margins are much better there.
So the retail side of the business is a completely different ball game. What we've established today is a fairly strong B2B business. So we have started actually, doing some retail sales of building wires in Gujarat and Maharashtra, particularly in these two states. So we'd like to go through that, step by step, just like how we built a lube retail business over the last 10 years. So we've started this activity. So, we are not really, as a company, a specialist in consumer distribution and stuff. But we've started in that direction. So over the next few years, you'll start seeing numbers increasing in terms of, retail sales taking place.
Okay, sir. Thank you so much, sir. That's from my side.
Thank you. Next question is from Maulik Patel from Equirus Securities. Please go ahead.
Yeah. Sir, on this order book, which has gone, I think in the last Concall you mentioned that because of the aluminium volatility, there were not many tenders coming up. So this increase in order book is partly reflecting that only, that earlier the tenders which were supposed to come did not came and now they announced and you got the order?
Partly it is the case, and partly it is on account of our customers who are having tenders which are delayed. Their business got concretized and then they placed in turn on us.
Okay.
And also there are a couple of new business like this copper conductors which also increased our overall order book condition.
Okay. So what is your best, from the experience, what size the copper conductor can we have it in next 3-4 years? Not immediately, because there is a large opportunity available at the railway also, which you mentioned. But could it be like 50% of the current volume which we are doing it, or probably just throwing some number there?
Well, we think over a period of time, maybe 10,000 to 12,000 metric tons in a year.
Okay.
Which
could be around 7 to 8% of our current volume.
But keep in mind that the price of copper is 3 times that of aluminum. So if you, so 10,000 tons in copper is equivalent to almost 30,000 tons of aluminum.
Okay.
So 30,000 out of 80,000, so that's 15-16% of the value would come from these copper conductors. And then when the CTC business kicks in 2020, that's also a transposed copper conductor again. So there we are actually, it's a very high value added and complex product. So there against this investment that we are making of approximately 45 crores, we would expect a revenue to come in which is about 3 times of that, meaning about 150 crores of revenue.
And again, the margin will be higher like what we do in HFC conductor?
Yeah, something in that range.
Okay.
Absolutely. Yeah. There's only 2 other manufacturers in the country, and the rest of it is all imported for this CTC.
And where is the application essentially of this conductor?
In the core of the transformer.
Okay. Got it.
Yeah. Okay. Thank you, Maulik.
Sir.
Thank you. Next question is from Divyata Dalal from Systematic Shares. Please go ahead.
Yeah, hi, good evening, sir. My question was pertaining to the oil business. There is, as you indicated, that on the export side we are seeing some pressure from Middle East and Africa. So if you can elaborate more on the issues which are being faced there.
Okay, so the issue is actually a little bit different in both these geographies. In the case of the Middle East, the real engine of investment is in Saudi Arabia.
Right.
And a lot of the project work there, has just got delayed. It's just slowed down substantially. So as a consequence, the orders which have been placed on various manufacturers either the manufacturing clearance is not available, or if they have manufactured transformers, the utility hasn't given them clearance for supply, of those transformers to take place. So as a consequence, we've seen the order book or the execution down by more than 50%, in Saudi Arabia. The remaining countries are relatively quite small. So that's on the transformer oil side over here. Now, when you come to the African countries, there the utilities and the individual customers are very cash rich, and they have a strong demand and a requirement. But the countries do not have enough foreign exchange. So the opening of letters of credit are getting postponed until there's adequate foreign exchange available. Now, some countries, the situation is starting to improve, like Nigeria, for example, where it had almost gone to a standstill on import, has now started improving on import with, the crude prices having gone up. So, in short, the problems in the Middle East side are more transformer oil driven. In the African area, it's more white oil driven.
Okay, sir. Any exposure here in these geographies that we have for our transmission business, either directly or through these EPC players?
So the transmission side in Africa is, we basically execute against aided projects. So either it's African Development Bank or World Bank. So that doesn't face this foreign exchange issue with respect to a particular central bank, of a country. But having said that, in fact, quite a few of our orders are actually coming from the Americas today. From Latin America, from Canada, some of the business coming from the United States, which are newer territories compared to Africa, which used to be the main area a few years ago.
This is on the power conductor side?
On the conductor side, yes.
Okay. So
and on the cable side also, we used to do quite a lot of export to Africa. Cable side export is a bit slower, but it's been more than compensated with a very strong domestic growth.
Okay. So going ahead, is it safe to assume that especially on the conductor side, we will see more of domestic execution, both in terms of current order book and newer orders flowing in?
So if you take the first quarter of this year, the order inflow was actually a fairly record high order inflow. Right. So 36% of that came from export, and the rest of it actually has come in from the domestic side. So yes, you will start seeing a higher percentage of domestic taking place compared to exports over the next couple of quarters. We do have a number of tenders which we have and requirements which we have bid against in North America. So if those come in, then again you will see a good increase on the export side.
Okay. And in terms of the type of tenders in domestic, would it be good to assume that most of them would be either having a PVC clause or will be formula based?
So most of the new business now in the domestic is against tariff-based competitive bidding.
Right.
So there will be no PV clause for the end client, but for us, with our immediate client, there will be a price variation formula for the bulk of the business. That is the way we wish to operate.
Okay. So from the current order book, can we give that breakup in terms of how much would be fixed price and how much would be with variation?
So even after the business is given to us, then the client has the option to freeze the price, in which case then we can hedge it. So maybe about 70% plus would be variable in that nature, of that type what I just explained.
Okay.
He's saying the variable when you get the order, but it becomes fixed before execution. Much before execution, it becomes fixed.
Once you get the order, that time you can hedge, and then it becomes
fixed. The client asks you often to hedge the price, so that it becomes then a fixed price for the client.
Okay.
Also, particularly the case of these TBCB, the EPC people who are supplying against the tariff-based competitive bidding.
Right.
So fundamentally, it's a fixed price, but we bid on a variable basis and push the client to then press the button, in terms of when they want to fix it for the rest of the execution.
Okay. And sir, in terms of Hamria plant, if you can throw some light, since the Middle East has been slowing down in terms of oil business, what would be the utilization there, and will there be any lower utilization going ahead?
So in the first quarter of this year, the utilization has been at around 64%. Okay. We can't compare it to the same period previous year because that's when the plant had just started up.
Right.
But if you compare it with Q4, it has certainly been lower.
Lower, okay.
Yeah, and Q2 is actually the slower season because that's the holiday season in the Middle East, where it's very hot and number of people go out of the country on their vacation. Right. Q3 and Q4 are the two strong quarters. So by September time frame we should be in a much better position to be able to tell how that is going to move.
Okay.
Yeah.
And sir, for conductors in terms of FY20, can we guide in terms of volume growth, given that the order book is strong, though you mentioned it is over 9 to 12 months, but based on the inquiries and the visibility for HEC, can we put some number for FY20, sir?
What we anticipate is that the conventional conductors will be in the same range, but what may increase is the HEC and the new variety like the copper conductors, OPGW. So those products may increase.
Okay.
Even the new product line that we talked about, the CTC.
Yes.
So those will be additional volumes plus some of the work that we are doing for reconductoring, where there is a service component. So there also it will have a boost to the overall value of the conductor business.
Okay. All right, so that's it from my side. Thank you and all the best.
Thank you. Next question is from Lalaram Singh from Vibrant Securities. Please go ahead.
Hi. My question is that within the three segments, conductors, oil and cables, is my understanding correct that cable is far more attractive business in terms of economics?
Well, in the cable segment, we've been able to position the business to improve in terms of its profitability, because we have been focusing a lot on our specialty cables. But if you otherwise just look at a plain vanilla power cable business, that actually is still having a lot of margin pressures. But because of the specialty cable side, we've improved margins. We are also looking at some of this optical fiber that's getting executed. But I made a comment earlier in our presentation that the cable side, the big advantage that's there is that the addressable market is much larger than conductors, and B, it has a huge variety of product. Especially a lot of specialty products are there. They may not be huge volume, but each of these actually has a meaningful contribution. If you get after it. So that's why we see that the cable side seems relatively pretty stable for us.
Okay. So within that 40,000 crores, how much would be that specialty part where you can make better margins for profitability?
So you're probably looking at about 10% of that. Because a large portion of the 40,000 crores includes building wires also.
House wire.
Which is house wire. About half of the market is house wire.
Okay, which is very competitive.
Which is, it has a B2B component as a B2C component, which is, the distribution like what a Phenolex would be doing or Havells or, it's a branded building wire business. So that's about 50% of the market. The balance 50% is the B2B market of cables. Now, of that, 20,000, you're looking at about 4,000 crores being, 3 to 4,000 crores being, cables which are special in nature, that include optical fiber.
Okay. And as of today, how much of our business would be specialty cable within the around 1,200 crore annual run rate?
So, last year, if you take our elastomeric and optical fiber business, we are looking at close to about 350 crores.
Okay.
So, most of the business, 25% of the business.
Okay, so effectively we can say that we are at around 10% market share in that market, specialty cables.
Yes, and the segment that we have relatively a very small market is actually market share is on the optical fiber side. So when you move into the market share which is there in the solar segment, railways, etc., there our market share is significantly higher.
Correct. So, we have been growing at a very healthy pace in this segment. So is this driven by taking the market share, or are these categories themselves growing at a higher rate?
It's both. If you see over the last 10 years, the least funded was actually the distribution segment,
Correct.
And as a consequence, a lot of the cable companies actually wound up and had significant problems, including ourselves, after we took over Uniflex cables 10 years ago. So now the investments are going in, as I mentioned in my opening remarks also, that the condition of discoms is starting to improve in terms of, the gap with respect to cost versus the selling price. The reforms are kicking in, they're getting their own internal accruals improving, plus they've got access to the refinancing of their loans. So capex in this segment should continue for the next at least 2 to 3 years, on the power cable side. The railways, there's a clear program for the next 3 to 5 years, on improving the railway side. The defense is probably going to run even longer than that, because this whole Make in India cables is one of the items that figures in being given priority to be manufactured in India. So, on the cable front, and then of course solar is another major area for us, where for the next 4 or 5 years you will continue to see a lot of investment going in on the solar side, and wind starting to pick up. So, all that put together, cable looks reasonably, at least the next 2 years outlook seems, pretty clear actually.
Understood. And if I take it a much longer term view, is it likely that cable might be the biggest business for us in the next, say, a decade or so? Is it possible? Are we looking at that in that direction?
Well, I mean, the conductor business, the gap between the cable and conductor business is pretty significant. With the conductor business being at, 2x of the cable business. But it's clear that over the next 5 years, the cable business will grow at a much more rapid pace, because the addressable market itself is larger. And some of these specialty cables, we've not even gone out of India, All this is all domestic business coming from the specialty cables. So, there's definite room to grow. It will be the fastest growing segment of the three over the next 5 years.
Understood. Actually, my question was to revise it. If we had, to choose between, to put money, if we had limited capital, would we choose cables or say conductors or oil? That is what I want to understand. I mean, with that perspective.
The way we, as a company, we don't have, the investment is actually driven more in terms of the fundamentals of the project,
Okay.
The return on the capital, when we invest in the asset, because the company has a fair amount of room available to invest through internal accruals as well as to borrow if there is a compelling need to do so, and the project is very attractive. So the situation is not coming by that it's a zero-sum game that I have X amount and I can invest either in conductor or cable. We fortunately have the luxury of investing in all the three segments depending on the quality of the opportunities that are out there, and that's the way we are looking at it.
Got it. That is helpful. Thanks a lot.
Okay, thank you.
Thank you. Next question is from Anuj Upadhyay from MK Global. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So one small confusion that it pertains to the conductor segment. That your adjusted EBITDA on a tonnage basis has gone up, whereas the margin for the segment has come down. Is it primarily because of a fall in volume, or it's some another link which I'm missing?
It's the fall in volume.
Is the volume. And secondly, sir, this order book of 2,436 crores in the conductor, by when we expect when we expect it to be executed?
It's about 128,000 metric ton, so should be executed typically in 9 months actually.
9 to 12 months.
9 to 12 months.
Fine, sir. Thank you.
See, what's happening on the conductor cycle, order cycle, is that the delivery cycles are much shorter than what they were 3 years ago. We've been mentioning that on our calls over the last several quarters, that as it goes more and more through the EPC route, the EPC contractors prefer a concentrated period of execution.
Okay. Okay. Thank you, sir.
Thank you. Next question is from BMA Wealth Creators. Please go ahead.
Thank you very much, sir, for taking my question. I would again like to get clarified on the interest side. Like Q4 and Q1, interest cost is similar. And as explained by you, this may continue till September of the current year. Do you see after that what is the trend for the interest rate?
Yeah, after these 4 quarters.
After September.
Huh?
After September.
After September. What we have said is that interest cost will be about 35 crores per quarter for all the 4 quarters of this year.
Okay. What is the component of 54 crores? Apart from interest, what is there in the finance cost?
So the breakup I mentioned earlier in the call, that your supplier's credit is approximately, the overseas supplier credit is about 10 crores. The domestic supplier's credit is around 12.5 crores. And our discounting costs, that's the extended credit given on sales, is about 6 crores. Interest on GST is about 2 crores, which should become half post September. And our term loan interest is a little over 3 crore rupees. So that's the composition of around the 35 crores that we have.
I suppose you wanted forex actually?
I wanted the difference, this 54 versus 35. 35 is saying it will remain constant.
That difference is open period forex, which we capture in the open period forex, which we capture in the EBITDA margin.
Okay.
16 crores, yes.
That will still stay, or will it change?
No. That 16 crore depends upon whether there is a depreciation of rupee dollar depreciation is there or not actually. But because we get compensated in the form of price, so that is why it needs to be adjusted against EBITDA.
Okay. And do you see any effect of profitability in terms of depreciation in lira?
Lira, Turkey. No, we don't have.
The entire business that we have in Turkey, which is actually run through our, the petroleum specialties FZE business out of Hamria, is a dollar book.
Okay.
So we don't take any depreciation. What the indirect effect if the lira depreciates is that some customers may find it a bit difficult because of the inflation that they see in the cost. But otherwise, our business is run on a purely dollar book basis.
Right. Okay. Thank you. Thank you very much.
Thank you. Next question is from Chirag Muchala from Nirmal Bang. Please go ahead.
Yes, sir. Firstly, can you please mention the order inflow for the conductor in this quarter?
About 1750 crores.
1750 crores.
Yes.
Okay. And any large HEC conductor inflow in this, apart from the copper conductor you have mentioned?
HEC is also there. HEC as a percentage of the order book is now close to about 13%.
Okay. Okay. And sir, second question is on the copper conductor side. So, we have received this around 400 crores order. So, any, further details regarding it, like, what are the terms, trade terms, basically, the, payment cycle, retention money, etc.
There is no retention money in this case.
Okay.
And it is going straight to it's a pure supply contract and it is being supplied to core. So it is relatively quick payment cycle.
Payment is about 60 days actually, 60 to 75 days.
Okay, and sir, is there any? Okay, and is there any price variation clause in this?
Yes, all of it is price variation clause.
Okay, and sir, for the rest of the year, what kind of tender pipeline is there for the copper conductor orders?
There are tenders going to come up, but we are sort of not probably having too much capacity left for production if we complete our existing order book. So as the business comes in, it will be more for the future. So accordingly, we'll fill up our capacity for maybe next financial year.
Okay, so sir, actually I was going to ask that question, basically currently in terms of metric ton, what kind of capacities we already have for copper conductors and any expansion plans there?
Yes, we have about 10,000 tons capacity approximately.
Okay.
And we may be slightly debottlenecking that further as per the demand in the domestic market, and in times to come we'll also start exporting.
Okay, and we are right now not planning any further capex to increase this capacity.
As I said, there is some debottlenecking is going on.
Okay, sir. And finally, apart from Indian Railways, is there any other customer that we can supply this copper conductor, or they are the only player in India who actually source it?
There are these metros in all these different cities, the metros are coming up.
Right.
So they are again another client base. Okay. And then similar railways are there outside India. So we'll be supplying to them in times to come also.
Okay.
And metro companies outside India.
Okay. And so this CTC conductor that we mentioned, 45 crore capex that we are doing, so that would translate to what kind of capacity in metric tons, metric tons point of view?
About 7,000 odd metric tons per annum.
Oh, right. And both of these are coming at Silvassa plant, right, sir, or the Orissa plant?
One is already come up, and that is the copper conductor for railways has come up, and the other one also will be in Silvassa.
Okay, sir. Thanks.
Yeah.
Thank you very much. That was the last question in queue. I would now like to hand the conference back to the management for closing comments.
Thank you everyone for your time and showing interest in the Apar earning conference call. Thank you very much.
Yeah. Thank you and goodbye.
Thank you very much.